All right, guys. How are you? We're good? Great. Dimitar found that everybody can drive and listen, so he decided to get in the car to see what's the experience like. All right, what we got? I got a ceiling light. I have a ceiling, another ceiling. Yariel's in the car. Giving you a heads up. The more time, Leslie found out that a car also is good to learn. Great. Let's see what else. All right, the here is off. Leslie just turned off, or she's back. Brian, no camera. Okay, I see how it is. I see how it is. All right. Dariel, my internet is messed. Let me go to the chat so you guys fun like I do. Tidy, I'm sorry. I said no. I will not explain. Sorry. All right. Dimitar says stuck the line in IKEA. I'm waiting for pickup. Gotcha. Yariel, my internet is messed up in my house, so I'm sitting in the car. Your internet in your car is better than the one in the house? Right? Quinny, IKEA is open? Yep, sure is. And Jeff, I just fixed my audio, so now we can all hear you better. All right. Melissa just wrote in the group chat, no crash or technical issues. Class is on. We're all here. Done. Okay. So, I only have one question regarding yesterday. It's from Tidy regarding the point. No, what is it? Regarding index and margin and points. Nobody else has questions? Okay, Melissa's on. Any questions? Questions? All right, so I'm going to go ahead and answer Melissa's question. I'm sorry, Tidy's question, and we're going to go. Whitney, you're funny. Just wrote quiet in every class, but as soon as I hear IKEA, I'm all right. All right, I just want to point out a couple of things before we start and before I start answering questions. One of them is, and this is very important, guys. You need to understand this. If your connection drops, make sure you come right back onto the class. That's the one thing. Second thing, I was pulling reports on this class to see the attendance and attention. Okay? Here's one thing I have to say. I do know that some of you have, maybe the house is a mess, maybe you're a mess. It happens. Sometimes it happens we're not ready for it to be on camera. I totally understand. But if it's Erica just laughed. But if it's the first time you're taking the class in this school, in this course, if it's the first time, it is imperative that you are on camera and participating. So you got to answer questions. And as I was pulling the reports earlier, right before class, some of you are not doing the full hours, or if it drops and it takes you a while to come back, or your camera is off for a long period of time. I get all the reports, guys, so it's very important. As far as the chats, the way I do, I can export the chat and I can break it down per user. And when I do, there's a lot of you not participating at all over the past 2 weeks. So very, very important. If I don't see you on camera, that's one. If I don't see messages from you, That's 2. And if you're not doing the full hours, that's 3. I cannot give you credit for the hours that you're spending here. You understand that? I cannot give you credit for those chapters. You have to complete at least 90% of the course, and that is participating, and I can visually see that you are there, not just a camera on. Okay? If you cannot have your camera on, at least show me that you're there by participating, by texting, by replying to the questions, and asking questions. You guys understand that? Very, very important. Some of you that are here know that I like to help everybody, and I'll do my best to help you. But I'll point it out again. I will not lose my license over anyone. So, as much as I love you guys, I will not give credit to those that do not participate and do not have all the hours. You guys got it? Give me a thumbs up if you got it. Those of you that have cameras on. All right, good. You have to understand, I have 2 jobs. It's way worse for me. If you guys think it's bad for you, it's way worse for me. I have 2 jobs. One of them is watching you guys and teach at the same time. The second job is after I'm done here, I have to pull reports, review the whole class again, not just the reports of the messages and participation, but also review the whole class again, the video, the gallery view, and see who was in and out. So I get different types of reports, but I still have to go through the class. So imagine me going through the whole class, right? 3.5 hours trying to skim through to see who's there and who's not. All right, so just being very clear, I will help you. If you have any issues, I will help you. If you cannot take the class at this time, you know what? The class is available for up to 1 year. So if now is not the right time for you, I totally understand and I will help you. All right, but you have to communicate with me and tell me, as some already did, and they're not in this group right now. You have to communicate with me. Things are tough. I cannot do this right now, right? I will help you. I don't know how many times I can say this, but I will. Okay? So make sure you're not just standing there on the other side, right? And just pretending to be listening, or actually just even muted. We already talked about this. Some of our students, they have it muted. Some show up for half an hour, 1 hour, and then don't show up again. So cannot help you that way. You guys got it? All right. Thanks, Michelle. All right. So with that being said, I'm going to address Erica. No, I told you I helped, but not you. You're gonna have to do the whole class again. If you miss one chapter, you can pick it up in a different class. So let's say the next class and that chapter is there. You can pick it up there. If it's just one day that you missed, it's okay. You don't have to make it up. Just review the video, the replay, and you're good. All right? If you have any questions while going over the replay, then you ask me, Bruno, I did not understand this. I did not understand that. And I will help you. All right, guys? That's why the replays are there, for you to watch as many times as you want, to listen as many times as you want. You can skip the jokes if you want to skip the jokes. It's totally fine. If you want to hear the jokes again, because I know they're that good, you can. But don't make sure you don't skip the rest of the material. But don't worry, Erica. You're good. You didn't miss that much. Aside from being late once in a while, missing one day is not a problem. All right. So let's go to the questions. You should be. So let's go up to the questions real quick. I had 2 questions from Eddie right here. What is the question? Can you go over index and margin and points? Those are the 2 questions. Same as Yariel. Okay. Listen, Erica, not as important as this class. Just saying. Finish around 7. That's kind of your problem. All right, so let's go over this. A recap. All right, so Yariel and Taida, you guys were asking me about the points I'm going to address that. Since both of you had the same question regarding points, and I'm pretty sure you're not the only ones with a question, I'm going to put it out here first, and then I'll address index and margin again. Don't forget, I did mention I have a video on YouTube, so the link is always in the group chat. The link is did you guys see the message that just came through? Gotta laugh. Okay, Natalia, no problem. So I have a video that explains in detail index and margin. Okay, I also have another video that explains points. But the one that explains about index and margins, if you still don't understand after the example I'll give you in a second, go to that video. It's more relaxed, the whole 15 minutes in detail about adjustable rate mortgages, right? So go to that one, index and margin. I'll still do a recap here. Okay, now as far as points, what I told you is that every time you see point, right, or 1 point, this equals 1% of loan amount. Okay, equals 1% of loan amount. So if we said that the property was purchased for $300,000, that's the purchase price, and the lender gave you a 90% LTV. Nobody answer in the chat, okay? Do not answer in the chat. I'm just going to go step by step right here. Don't put any results in the chat. That's not what I'm looking for right now, because I don't want to confuse anybody by some of you being a little faster or there's a little slower, you know, and it's okay. So don't put anything in the chat. I appreciate that. So we have $300,000 purchase price. There's a 90% LTV, and the bank is asking for 3 points to reduce the to reduce the rate. So 3 points, right? What I want to address is that the current rate is 6 1/4. Right? And if you pay the 3 points, they will reduce it to 6% for the lifetime of the loan, which is 30 years. Okay. Where's Uriel? Uriel, you got it so far? You good? Tidy? There you go. All right, we're good so far. Great. So, again, 1 point, let's go back to this, equals 1% of the loan amount. So before we even go and calculate anything else, let's say there was more questions here, right? Let's say the question developed more here. The first thing we need to figure out is, first, what is the 9%? Second, what are the 3 points, right? The 90% LTV, the LTV is the max loan that they'll give you, okay? The maximum loan that they'll give you. And the maximum loan they'll give you is 90% of the purchase price, all right? So what is 90% of 300,000? Okay, this is the loan. Ariel, good so far? Patty? Or is she? I lost her. Ah. Did I lose her? Okay, there you go. All right, Teddy, you good so far? All right. So make sure you guys paying attention, because I am addressing at this moment the two of you, but I know more of you have the same question. So make sure you are paying attention. So we've reached step number 1 of the question, which is figuring out what was the loan amount. Now I just wrote up here that 1 point equals 1% of the loan amount. But I always said, which is very important, 1% of the loan amount, not purchase price. Okay, so not the purchase price. So that means that the 3 points equal 3%, again, of loan. All right? Hold on a second, because I'm getting a good service right now. Hold on. Much. See the man. Just got some coffee. See, my agents are the best. All right, so 3 points equals 3% of the loan. Now, what is 3% of the loan? First of all, what is the loan amount? $270,000. What is 3% of that? That's what we're going to figure out. So on your calculator, times 0.03, which is 3%. And that would equal, I appreciate it. Thank you. Jonathan goes, I snap my fingers and get the coffee delivered. Yeah, that's how it is. My partner just wrote on a chat, on a WhatsApp chat, your agents. Yes, Pedro, since you got nothing else to do but to listen to my conversation with my students, they're also my agents. We are partners, right? That's what it is, period. All right. Let's see. 8,100. Was this correct? Did everybody understand what just happened here? Gabrielle, let me know in the chat. Patty, let me know in the chat. Anybody else that had a question regarding this, let me know in the chat if you got it. Whoever had a question. If you already knew it before, if you already understood it before, you don't have to. But if you still have a question, let me know now before I proceed. You're good? All right. Gabrielle is good too. Is there anybody that still does not understand this? It's totally fine. I'll explain again. All right. All right, so I have no questions in the chat, so I guess you guys all understood this. All right. Let's move on to the other question was index and margin. Let me know in the chat before I start. Is anybody else confused about index margin? Nobody wants to participate today. What's going on? I could use a refresher. Good. Thank you. Okay. So my question is, you guys understood this graph, right? You understand this graph, right? This is like the stock market, or it could also be the EKG, right? Your heartbeat, whatever way you want to look at it. And this is a heart attack waiting to happen when you see your stock drop. So that's why I compare it to an EKG. But the stock market is the index, goes up and down. So this right here is index. Okay. Good so far? Patty, you had a question? You're good? All right. So index. This is what we measure interest rates against. All right. In fact, an index is something of measure, right? Something that indicates a benchmark, a performance, right? So in this case, is how the market is performing. We use traditionally the 1 year treasury bill, but it could be the 6 month or 12-month LIBOR rates, for instance. It could be based on the S&P 500. It could be based on whatever, Yang Seng or any other tradable markets, right? So in this case, 1 year treasury bill is the most commonly used for mortgages. And we look at what the market is doing with the treasury bill, so these ups and downs, right? And we'll determine that every 6 months or every year or every 3 years or 5 years, we're going to adjust your interest based on where the stock market is for this particular index. So that's why I put here the numbers for the index. So 2, 4, 6, 8, 10, 12, 14, 16, 18, and so on. And then on the bottom, I put 1 year, 2 years, 3 years. So I'm assuming we're doing, it was determined that this type of mortgage was based on a whole year anniversary period. Okay? Let me know at any time. If you want me to stop, just tell me stop, explain again. All right? So we're looking here at 12 years so far. And what we're going to do is, on the anniversary period, so 1 year later, your interest is locked for 1 year. So it starts at, we start off at 2 right here. But 1 year later, let's adjust. Okay, 1 year later, let me zoom in. Can you see it? 1 year later, the interest is at, the index is at what? It's at 4, right? And then 1 year later, let's adjust. It's at, let's say, 5. Okay? And then 1 year later, it's at 10. So as you guys can see, like right here, another year later, it's at 4 again. So it's based on the index. It keeps on going up and down and adjusting accordingly. So we started off with a 2 index. We went to 4 index, to 5, to 10, and then down to 4 again in 4 years or 5 years, right? So that is the variable that you're going to have in this type of mortgage. Now, margin equals bank payment. Bank payment. So what they're saying is the bank wants to get paid the difference between interest and index. So how do we figure that out? Well, index is the market, right? And then interest is the charge. Okay. So let's say we have a 2% margin, and right now we're at 4% index. What is going to be your interest? We're going to add these two. So your interest, your effective interest is 6%. Are you good? We're good so far, guys? Anybody has a question here? No. All right. 1 year later, what happened to the market? Let's go back here. 1 year later, it went up to 4. Well, actually, that's how I started. I'm sorry. So 1 year after that, it went up to 5. And let's say on the third year, look where we are in the third year. We're at 10. So the concept is the same. What we're going to do is, I'm going to erase here the 4. I'm going to add 10. What is the new interest rate? 12. Okay. Did margin change? The margin never changes. The margin is 2% above index, is what the bank gets paid. So technically what we're saying, because the following year, Shaisha, I'll address it in a second, but because the following year it drops to 5, so does the interest. So what we're saying here again is that the bank, in an adjustable rate mortgage, they shift the risk of the index increasing or the benefit of the index decreasing, they shift that risk or benefit to you, the borrower. So if it goes up, well, you pay 12%. If it goes down, you pay 7%. But the bank locks their payment, so addressing Shaisha right now, they lock their payment at 2% margin. So what they want to get paid is whatever index is doing, just add the 2%. That's my payment as the lender. And what you pay me is 7% interest in total. Because we're borrowing money based on 5% index, you're paying me the 2% above. Okay, that's my profit. That's what I get paid. You got it? Yes? The bank always locks it at 2%. No, it could have been a 3% margin. It could have been a 4% margin. It could have been a 5, could be a 10% margin. But the margin, you guys need to remember, I said this yesterday, margin, cap, and lifetime cap or ceiling, these are locked right in the beginning. So whatever we decide, it stays for the lifetime of the loan. The only thing that always varies throughout the 30 years is index. Index always varies right here. This is index. This varies. You got it? Courtney, shifts the risk, the benefit to the borrower, but the bank stays the same. Look, the bank actually doesn't stay the same. You have to understand one thing, okay? So, Courtney, you have to understand one thing. What we're saying is, if we had a fixed rate loan, right? Let's say you have a fixed rate loan. What happened here? What am I going to do? I'm going to put green. Let's say you had a 5% fixed rate loan. You see it? Okay. That means for the lifetime of your loan, you're at 5%. What happens to the bank and their borrowing? See? It's costing them more right here than it's costing you. You're just paying 5%. So when we say they shift the risk or reward to you, is because in an adjustable rate mortgage, you deal with these market changes. You deal with the ups and downs. If it's a fixed rate, you pay the same amount and the bank either loses or gains. So they gain when the market is down here, and they lose when the market is up here. You understand it? So they shift it to you. Courtney? Got it? Okay. So they just want the 2% above, and whatever the market does. And you have to understand, 2% on a 12% interest is different than 2% on a 6% interest, right? Because you're paying more on 12. You got it? If you guys look at it, if I borrow $100,000 at 2%, and I mean, if the fee is 2%, then it's $2,000. But if you're borrowing $200,000, then how much does the bank get paid? You get $4,000 as an example. So that 2% varies as well. Jasiel is asking, okay, let me go chat. All right, so Jasiel is asking, what's going to determine that? Credit? Let me ask the question. I mean, I want you to ask the question a little differently. What are you trying to see here? What's going to determine what and why credit? What's going to determine your margin? What's going to determine your ability to get the adjustable rate? Okay, the margin. So could be credit, could be bank guidelines, could be a combination of different things. So what the market is doing currently. See, right now, if you guys understand, so if you guys understand what's happening to the market, a lot of lenders are now holding back. But like, we used to be giving 100% loans till the whole quarantine, but now they're already starting to step back. They went to 20%. Then they find a way to work with the guidelines, the government grants and all that stuff, and now they're back at, okay, if you have 5% down or 3% down programs, we'll work with those again. 580 scores might not be available yet. 590s, 600s, right? So they immediately, when the market got hit, they already step back because a lot of people are going to lose their jobs, right? So, or might lose their jobs. So what determines what the margin is going to be? Well, where the bank is at this time, where the economy is at a time, your credit and your income, so your financial stability, all of it is going to affect your ability to borrow money, right? And what they demand from you. If you have low credit, could they charge a higher interest rate? Sure, just like premiums if you have a driving record or if you live in a certain area. You got it? So could be determined by several different things. All right. Did you get it, Josiel? Yeah? Okay. Then that says, in the review questions are for chapter 14, question 2, I answered D, but the key answer is B. Did we go over those already? Quick. All right. Then that's this one. Where is the screen? Hold on. Oh, there you go. All right. Is it this one? Hold on. I'm not showing you. This one? Okay. So it says a borrower obtains a $150,000 mortgage loan at 5% interest. If the monthly payment is $805.15, are credited first on the interest and then on the principal. What is the balance of the principal after the borrower made the first payment? So, do you remember page 195? Real quick. Right here, we had a similar question, similar steps, right? Yes? Okay. So in this case, it's 150,000 instead of 100,000. It tells you the years, all that stuff. And these are the steps. The first thing is figuring out what's the annual. Then you divide by 12, right? Then it's the 805 minus that 12. And there's an amount that went towards principal. So what they're asking is what's the balance after you pay, right? So let's go through these steps in the question itself. I just wanted to make a reference to the section where this thing is. So if you're on question number 2, page 195 tells you what to do. So what do we have here? We have 150,000 mortgage at 5%. The first thing you have to do is 150,000 times the 5% or 0.05, and that gives you the annual interest. Okay. Right. What am I doing? I just drew a blank. I'm good at math. $7,500. This is the annual. Okay. What we're gonna do next. All right, we got the 7,500. Going to divide by 12. That's 625 monthly. Okay, here so far? Okay. So the payments 805.15 minus 625 equals 180.15. 15. All right, so let's go by steps. This is 1, 2, 3. Step 4 is total amount that you borrowed minus 180 that went towards principal. The answer is 149, 8, 19, 85. Okay. So where did you had answer D, you said? So did you understand, or where did you get stuck? If you don't mind, tell me in the chat, where did you get stuck? I'll leave this up for a second while you enter it in the chat. I have a few cameras off. Make sure you guys taking this for the first time, turn on your used 808 as the first payment. Okay. So you made a mistake on 5. All right. You see how easy it is to make mistakes? Not that you don't know. Reading. Putting down the right numbers. Yesterday we had typos. Yesterday we had I didn't read it right. Right? Mainly Sarah. She didn't read. Wrote. I don't read. So it's key, guys, that you pay attention to what you're doing, because one small mistake, one number, so one number, if you see here, one number, it's a big difference. Got it? Shaisha is asking for a substitution. Everybody else will tag in. Yeah. All right, Shaisha, it has to be you doing the class, not somebody else. That's what we do in basketball. Like, come on, coach, somebody else, somebody else. Oh, you're telling your son to run? Okay. Oh, I could say right now, but it would be. All right. By the way, guys, I just looked at Jeff and I remembered the sound thing. That you fixed the sound. How's my sound? Is the microphone still clicking? Is it still freezing? Anything blurry? You're good? Okay, great. All right, so let's go back to the screen. And I think we're good to go to the second part of this chapter, or does anybody have questions? Tomorrow, was this a good refresher? Because you had asked before, because it's a refresher. Okay, great. All right. Let's go. So we are on page 197. Page 197. Is everybody there? All right, so here's what we got. Your home loan toolkit. Yesterday we talked about fixed rates, adjustable rates. We talked about interest only. All right, make sure you guys paying attention. If you guys are talking, you're fired. All right, Miss Martinez there saying. So we went over all these things. Now, is there anybody here in the and obviously if you've taken this class before, it's different, right? Is there anybody here in the class that started this session? It's the first time doing this, right? This class. Is there anybody that knew fixed rates, adjustable rates, interest only, points, and all that stuff, PITI? You knew all of it? Okay, Tamori already knew. Great. Anybody else? What's up? Okay, Tidy already knew. All right, you already took a class. All right. Sandra, nope. Ahmad, I knew some, but not all. Just yell, which Martinez? Don't worry, it's all of you. I'll blame all of you. Anyway. Maurice says, I had some knowledge. Shirley says, no. Good. Well, here's the thing. Some of you that raise your hands are already homeowners. Some of you are not. The ones that are homeowners should know all of this. You know why? Because you should have been given, at one point, your home loan toolkit. Now, this is a pamphlet that is provided to you by the lender. They are obligated to provide to you. Dimitar, are you using the 12th edition book? That's the physical book? All right, so if it's the 12th edition book, look at page 193 or 194. And it doesn't say your home loan toolkit. It's a buying or buying your house guide or something like that. Or your home loan, no, something like that. I forgot what it was. I'm sorry. But page 194. Because page 193 is the chart, so it should be page 194, maybe 195, the worst case scenario. It's going to be there. Either way, it doesn't tell you the same things. If you're using the 12th edition, I'll tell you right now, there's a lot of changes when it comes to mortgages and closings. So make sure you have the PDF version at least, or if you want the actual book, we can mail it to you. Unfortunately for an additional charge because it costs us money, so we just pass it through to you, the charge. Okay? Now, Dimitar, I'm just letting you know that there's just a few things. I know you're using it just for the class, but there's a few things. This is one of them. It has something similar to this, but the name is different because the 12th edition was written before October 3rd of 2015, and all the changes we have in this book right now are based on October 3rd, 2015, which was a few laws by the Consumer Financial Protection Bureau that went into effect after the mortgage crash. Okay? Now, there's already a 2014 edition coming out because obviously we did have more changes along the way since 2015 to now. There's a 14th edition which I just ordered today for me to see what are the differences between the previous book and this book. I am not telling you to get the 14th edition. I am telling you to make sure you pass before you have to buy the 14th edition. Okay? So by October 1st, we're going to definitely convert to either the 14th edition or the national book and then have a New Jersey portion only. It'll be different than the book we're using now. Just letting you guys know. By October is definitely going to be different than what we have now. We will most likely figure out a way to help you guys out, but you might have to pay for, if you haven't yet passed, you might have to pay to get either the book or just the portions that are different in the book, okay? But we'll figure it out then if you get there. I just hope you get it done now. Just yell, will the test change? I'm letting you know right now, the test does not change that much, but there are a few laws which I'm going to point out from now on. There are a few laws that I keep on enforcing because they have changed these few things in the exam. So 90% of the exam is still the same, right, from the previous exams. It's just that now they incorporated 2 or 3 things that were changed in the law, and those 2 or 3 things amount to probably, I don't know, 10 questions, maybe 12 questions. You got it? So, but you have to know what they are. Let's go back to this real quick. Your home loan toolkit. I was saying that homeowners, you should have this already because it says lenders right here are obligated to provide the booklet to borrowers within 3 business days. We're going to repeat this a million times. 3 business days from their completed loan application. So they have to provide you with this. And tomorrow we're going to talk about loan estimate. They have to provide to you also with the loan estimate. How much is it going to cost you to borrow the money? So within 3 business days of the application. This is key. Like I said, we're going to repeat this a million times. Within 3 business days of completed loan application. What I want you to see next is this. No one is actually responsible for explaining the contents of the booklet. So guess what? If you ever purchased something that you had to assemble, if you ever purchased something you didn't have to assemble, if you ever purchased something, period, it comes with something called the instruction manual. Nobody's obligated to explain it to you, but it's there. You understand? Do you understand my analogy right now? The booklet is provided, just like the instruction manuals for stuff that you buy is provided. So they have to explain the instructions to you. No, the booklet is provided. Done. Okay? Jeff just wrote, they do the same with discharge notes in the hospital. Well, I hope they explain a little bit about the discharge notes. I mean, you're going home and you're still not well. We're just kicking you out. At least I hope they explain, take this pill, go to your doctor. This is what I saw, right? I hope, Jeff. I don't know which hospital you go to, but I understand what you're saying. They just explain a little bit and like, okay, out. Jonathan wrote, it's like the IKEA furniture, for example. Sure. How about your TV? How about the computer you're using or the phone you're using to be on this Zoom chat right now? How about those? All right? Because I'm pretty sure it came with manuals, and I'm pretty sure none of you ever looked at it other than to unbox it. Oh, there's papers. Close the box and throw it in the garbage. I'm just saying. Right? Who actually reads the instruction manual? Tell me in the chat if you actually read the instructions. Liars. Liars. Those of you that are saying me, and me, I can guarantee you probably read instruction manual. Page 1. Page 2. Out. You did not read the whole instruction manual for everything. Guarantee you. Guarantee. Alright? Just see how it looks at the pictures. Leslie says she's not lying. Sure. Okay. Even your car Tahira, you read the instructions of how to turn on the car, turn off the car, how to set up your radio, where the light bulb is, where the fuse box is. You read everything in detail. Steph, depends on how difficult it is, of course. Alright. I'm just messing with you guys. It's just that in reality, most of the times we don't read anything that's given. The point here is, okay, let's figure out first one thing. What is included in this booklet and why, just like the instruction manual. And by the way, I'm a culprit as well. I don't read instruction manuals. I try to figure out on my own, and then if I can't, right? Go ahead, ladies. Typical man, I know. I try to figure out on my own, and then if I can't, I will resort to Google. And then if I can't, I will resort to YouTube. And then if I can't, okay, fine, let's look at the instruction manual. But reading a book is definitely not for me. And I've said that a million times. I'm sorry. It's my way of being. So if the furniture in my house is upside down, you know, it was YouTube. I'm just saying. Now, why do you need to know what's there? Right here. And I'll go back up in a second. Right, my screen did update. Go into the chat while this updates real quick. So Jeff wrote, I learned my lesson when I tried to do without the instructions. I had screws and bolts warping the cheap wood. So you're talking about IKEA, right? Okay. They do have some nice stuff that's not cheap wood, but depending on what you're buying it for, yeah, I would use the cheapest one too. Shirley Resende, I read it when I need it. It even rhymes. That was perfect. Let's see. Screen still did not update. That's good. Second. No. Sorry guys, just 1 second because it's not updating the next screen on the book. All because Dimitar talked about the 12th edition. Now I cannot show you what's on the 13th edition. So guys, you can blame Dimitar for this. Just saying. And he writes no problem. All right, now we got it. Boom. There you go. All right, cool. So I was going to show you what's included in this toolkit. Very important. And it says right here, it includes how to determine affordability. Do you think it's important to know if your client can afford it or not? Let me know. Thumbs up. What do you think? Yes? No? Yes? Great. It's important. How credit scores affect the availability of mortgage money. Do you think this is important? Yes or no? Absolutely. How to choose the right mortgage and down payment. Maybe? Yeah, of course. Understanding the trade-off between points and interest rate. You guys already understood that you could pay points up front in order to reduce the lifetime interest rate. Is this good to know or not? Right, because if you have extra money, why not put the extra money to reduce the interest? If it's a 30-year mortgage and you don't intend to sell it within the next 5 years, then maybe it's worth it. We went over this yesterday. The value of shopping several lenders. They have to give you what's the APR, what's the actual true cost of the money. We'll go over this in detail tomorrow. But they have to tell you the actual cost of the money so you can compare with different lenders. So you go to Bank of America and they say, hey, 5%. You go to Wells Fargo and they say, hey, 6%. You're going to go to TD Bank and they say 5.25%. Isn't this important to know? Do you think this is good or this is bad? Great, right? So you need to know this stuff. And last but not least, probably the most important for me is how to avoid pitfalls and handle problems. So pretty much this booklet tells you up front what is a loan, should you be prepared for it, how and why and how, right? And if things go wrong, also how to handle it, right? This booklet is very important. It's like the troubleshooting portion in your manual. So I was comparing to the manual. It's like the troubleshooting. Okay, if this is wrong, try this, try that, and so on, right? Now, I told you that it's provided to you. They have to provide it to you, right? The lender is obligated to provide it to you, but they don't have to explain. Now, my question to you guys is very simple. You guys are real estate consultants, correct? That's what you're going to be, real estate consultants? Yes. As real estate consultants, do we have anything to do with the mortgage? Let me know in the chat. As real estate consultants, do we have anything to do with the mortgage? Yes, we do. Absolutely, we do. We don't prepare the mortgage. We don't handle the mortgage. But being real estate consultants, this is chapter 1. One of your responsibilities is to help negotiate real estate loans. One of your responsibilities is to care so much for your client, that you're able to explain the different types of loans and prepare them for it even before they talk to an agent, a loan officer, I'm sorry, right? So even before they start looking for houses, it is your duty to explain these things to them, guide them every step of the way. You don't have to know mortgages in depth and what the most recent program is, what the interest rate is, you don't have to know all this, but you need to know enough so when you talk to the professional, you ask the questions. Okay? You guys understand this? So you should have a copy of this booklet, and you should be able, right here, Consumer Financial Protection Bureau, right here, suggests that real estate licensees provide and discuss the booklet with their buyers as soon as practical, even before the buyers consult a lender. You are the pro. You're the first point of contact. They're going to ask you all the questions. All you have to do is say, hey, I don't handle this, but these are the things you should be looking out for when you talk to a lender. You understand? It's not my side of it. I'm not the one lending you the money. The lender is. But these are the things you should look for when you're looking for a loan. By doing this, you guys are reducing the amount of deals that will fall through because the buyer was not ready. You guys understand? You know how many times you get into a contract and it falls through because the buyer forgot one thing or did not understand one thing or did not understand another thing, and then all of a sudden, boom, you don't have a buyer anymore? Okay? So it's very important you guys go through this. And here's the booklet. You can even get it in Spanish if you want, okay? But get the booklet. Very important. Understand that booklet. Explain it to your clients, right? Very, very important. So that was the first part of the booklet. Explains all that, how to get into a loan and what you should be looking for, what you should be ready for, and so on, right? The second part right here includes what we're going to talk about later, which is the LE, or loan estimate, and it includes the CD, which is closing disclosure. An LE is the document that's provided in the beginning that says, hey, if you borrow from us, this is how much you're going to pay in interest and penalties and fees and whatever. So everything is given to you up front. The closing disclosure, and don't worry right now because we're going to go in detail. The closing disclosure is at the end, right before you close. They give you a heads up. Hey, remember the LE? Now it's the CD. Make sure you compare both of them. There shouldn't be any changes, and let's close. Does that make sense? So it's pretty much repeating everything that's on the LE, but maybe a little bit more in detail. You guys get this? All right. We're going to go over this in detail in a little bit. Now we're going to go over conventional, insured, and guaranteed loans. What is a conventional loan? I had already started talking about it yesterday briefly. But what you need to remember is that a conventional loan, is arranged entirely between the borrower and lending institution. So take a note. Conventional loans are between the bank and you, period. Nobody else interferes. Nobody else gets involved. It's the bank guidelines. So if I'm the lender, you're the borrower, and I tell you, hey, you got to have a 640 score. You got to have an income of 3 times whatever the mortgage is going to be. As an example, let's say this is what I'm looking for. It's my guidelines. You guys understand? It's not the government guidelines. It's my guidelines lending to you. If you're approved for my guidelines, we'll move forward. If not, then we have to look at different other different options. For instance, the FHA or the VA. I'm here trying to erase just one. Okay, there you go. All right. So when we're talking about FHA, these are government-backed loans. They're either insured by FHA or guaranteed by the VA. Okay? Let's do this. If you see the word guarantee, we're talking about a VA. If you see the word insured, We're talking about FHA. But again, these are government-backed loans. So you still get it. The actual loan still comes from a lending institution like Bank of America. Let's say I'm Bank of America. I will lend to you, but you don't qualify for a conventional. So now let's look at these government programs and see if you qualify through these government-sponsored programs. It's still Bank of America lending to you, right? You guys get it so far? It's still Bank of America lending to you, but according to government guidelines. So they get a benefit from the government to lend to you. And that benefit comes in the form of an insurance. In case you default, they get covered. So Bank of America, I get covered, right? Or a guarantee by the VA, because in case you default, I am covered. So that's pretty much what it is. Here, in the conventional, government is not involved and is not protecting the lender at all. Here, government-backed loans, right? They are protecting the lender. It's never you, it's the lender. They facilitate the purchase by reducing the down payment requirements, right? So an FHA is 3.5% down payment instead of 20%, or yesterday we talked about 60% down payment. You remember that? Back in the 1920s, all right? So instead of doing those large lump sum down payments, they start dropping it down more and more through this type of program. All right, and there's not many countries in the world. There's not many countries in the world that have this type of option. So that's one of the things that I like about this country, is that you're able to be a homeowner with little to no down payment. You guys understand? So that's one of the advantages. Jasiel is asking, so the bank loves FHA instead of conventional loan? Not really. Because in a conventional loan, you do put the down payment. So either way, they're safe. You got it? So they're protected in both of them. The difference is, Jasiel, the difference is here, the government protects the lender, right, and helps you buy. Here, the bank hires a separate company to insure the loan. All right? So they pay for that, and then they ask you to pay what's called PMI, which is private mortgage insurance. But we're going to go over this in a second, okay? So don't go too crazy. All I'm trying to show, guys, and make sure you guys don't leave in this section, because we're gonna confuse you a little bit, maybe. So I want to make sure you ask as many questions as you can. But the difference is, here the government is facilitating you the purchase while protecting the lender. Okay? Here, the bank decides if they want to facilitate the purchase or not. If they want to allow you to put less than 20% or not. Okay? That's pretty much the difference. Yes, Jasiel. We'll address that in the next page. What else do we have? Out of here. The other thing we have is loans directly from the government. So up till now, if you guys see, the actual loan comes directly from a local lending institution. So whether it's a conventional loan or a government-backed loan, they come from the local lending institution. But right here, there are some loans that come directly from the government. And these are the NJHMFA mortgages and the RECD mortgages. So it's either the New Jersey Housing and Mortgage Finance Agency or it's the Rural Economic Community Development Agency. They lend to you directly. These are government programs, right? So it's not a government-backed program. It's a government-sponsored program, so directly to you. So if we go here to the next page, we're on page 198 right now, guys. We're going to talk about conventional loans. And in conventional loans, you guys already know that in making conventional loans, lending institutions set their own standards within the scope of banking regulations. So I'm the lender, I make my own standard guidelines. If you qualify, great, I lend to you. If you don't, let's look at other options. We already covered this, right? What we didn't cover in detail was this. Tamori, I'll address that in a second. Yes, I have, and I do recommend a lot of people to try participate, but I'll address that in a second. Private mortgage insurance, PMI. Okay, private mortgage insurance, PMI. PMI only exists for conventional loans, right? I'm going to show you why. There's something similar, but it's not called PMI for FHA, all right? So for conventional loans, we call it PMI, private mortgage insurance, because you get a private insurance company to insure the difference, all right? While the government-backed loans, they're backed by the government. So you don't have a private mortgage insurance. You don't have PMI. You have something called MIP, which is very similar. But again, I'll address in a second. Now, in general, conventional loans, we talked about this regarding the 1920s, right? Conventional loans call for a higher down payment, which is a lower LTV, than do the government-backed mortgages. We went over this as well, right? Banking theory holds that it risks depositors' money to lend more than 80% of the value of the real estate. So whenever the LTV is higher than 80%, it becomes risky for the lender. You understand? That's why traditionally they ask you for a 20% down payment. But every time you have a down payment below 20%, in a conventional mortgage, you must come with PMI. Okay? If it's less than 20% down payment in a conventional mortgage, you get what's called PMI. If you're able to put the 20% down, then the bank is not worried because the market really needs to fluctuate crazily, like in 2009, right? That needs to happen, and that was a freak situation. It's not the market does go down, the market does go up, but traditionally not more than 15%. So 10 to 50% change up or down is normal. Do you guys understand? But the huge drop we had is something that's not normal. So the bank says 20% is safe for everybody. Come up with 20% down payment. If you don't, then you have to pay a separate fee to a private mortgage insurance company that will assure us, the lender, that if you default, we are protected in the case of a loss at a foreclosure. Okay? It's like gap insurance. Have you heard of gap insurance for the cars? Right? Gap insurance is if there's a total loss on the car, for example, right? The insurance company will pay the value of the car at the time, the total loss value. But if you owe more than what the car was able to be paid from the insurance, gap insurance will cover that difference. So very similar to PMI, if they're not able to recover everything in a foreclosure, then they activate PMI to get more. You guys got it? Okay. So what do we have here? Questions. Can you drop PMI? Oh, we'll be getting there, actually. So here we're getting to that. Brian, I did not read that. I was wondering why you had this weird smile on your face as you were writing that. Yeah. And it's so funny that roughly, what time is it now? Okay, 6:56. Yeah, roughly 3 hours ago, I was talking to somebody about that. But it's not raining. So what we got? Can you still go with a conventional loan with a down payment lower than 20? Natalia, yes. If you qualify in terms of credit and income, yes. But then you have PMI. That's all it is. So PMI only comes in if you're doing a conventional with less than 20%. Okay? I'm sorry, Nanette. Your question is, so let's go here real quick, and then I'll come back. Your question is this extra interest rate, to whom you pay it? Well, I'm not sure, Nanette. What extra interest rate? You're talking about the PMI? Well, PMI is not an extra interest rate. It's, so Marisa just wrote, it's not an extra interest rate. It's insurance premium. So it's like you have your car loan payment, right? but then you have car insurance. It's an additional monthly fee that you have to secure any damages to your vehicle or to somebody else's vehicle. So in this case, you'll have a private mortgage company to pay to, but it goes out of your escrow. So you pay the bank with your monthly payments, and they separate to PMI, they separate to taxes, they separate to insurance, they separate interest, and then whatever's left is principal. It is different than house insurance, yes. Again, house insurance is to protect everybody, mainly the lender because they've invested in you and your property. PMI is to protect the lender, period. Doesn't, like if the house burns, PMI does not cover it. You got it? Okay. Let's see what we got here. Oh, Blas is here. Welcome. Just got rid of my PMI. You just got rid of your PMI. I mean, making double payments like that, I would be able to get rid of it too. So that's pretty good. All right. The net says I froze. Am I frozen, guys? Am I frozen? No? Okay, good. Let's see what I got here real quick. Make sure you guys have cameras on. Okay. All right, you went from a 2-3K to conventional. Perfect. Perfect. Tahira just wrote, internet unstable warning. Is that yours or mine? Because I didn't get any warnings here. So let's go back to this. Okay, back to the book. What do we got? Here's a notice. I always talk about this because it's very, very important. Not for state exam, not as much for state exam, but let me zoom in real quick. I don't know if you guys can read it well enough, so that's why I'm zooming in. Can you guys read it? Is it clear? I mean, if you cannot read it with this size, then I don't know. Steph is even clearing her eyes. She's like, oh, that's too big. Okay. This is not life insurance. Why do I stop here and I say this is not life insurance with the book? Because the book talks about PMI, and PMI again. So Nanette, let me address that to you as well. You said, does it have anything to do with or doesn't have anything to do with the house insurance? No. So house insurance protects the house in case there's damages to the house. PMI protects the lender in the event of foreclosure. If you die, okay, or let's put it this way because unfortunately it's a reality, when you die, if you don't have life insurance, I've addressed this before in a different chapter, right, when we talked about his cheat. If you don't have life insurance, then the bank does not get paid. And whoever survives you, so your significant other or your heirs, whoever survives you, now have to come up with the money by himself or herself or themselves if it's the kids, right? So this is not life insurance. You should, and this is a recommendation I give in every single class for the past 4 years, make sure, guys, at least get a term policy. At least, that's like worst case scenario. At least get a term policy for the 30 years of your mortgage, for the balance of your loan. At least, if you cannot afford anything else. This is your biggest investment in your life. And people forget to insure. We'll insure a car, we'll insure your phone, you'll insure your TV in case there's damages to the TV. But a lot of people forget to insure, which is the biggest asset or the most important asset that you have, which is your life. Right? You guys understand? So make sure all of you, very important, doesn't matter your age. A lot of people, I said this, when you're too young, you're like, I'm going to live forever. It does not matter your age. Insure yourself. Okay? If you're that young, you can afford something better than term policy. Okay? If you got kids, so let me talk to the parents real quick. If you got kids, And here's Shaquille with one. If you got kids, get life insurance on your kids. You're not predicting them to die, but you are preparing them for the future. A life insurance that accumulates cash value, for instance, it's a nice savings program for college, for instance. It's a nice savings program because your kids are amazing. They're going to get scholarships and all that stuff. You don't need to touch that money, but you can use the money to buy a house. Who was that saying hi to me? Steph, I saw that. All right. I was looking at the camera, but I saw some movement and somebody waving. But make sure, guys, so important. Use as many tools as you can. The wealthy people do it, but they are taught in their special schools. They are taught by their special elite groups. You should have it as well, these resources. All right? That was your sister? Say hi to your sister. Was she saying hi because I talked about life insurance and she wants to make sure you insure your life so she gets everything? Is that why? Okay, that was not it. Okay. But guys, I'm dead serious about it. I've been talking about this for years to all my students. And I do financial planning, life insurance, all that stuff. That's not what I'm promoting at all. I'm not asking you to come to me, not at all. But I am educating you because that's what I am first. An instructor, an educator, that's what I am first. All right? So it is my fiduciary duty to explain to you guys that you have to prepare yourselves for the worst always. Right? Because we never know when it's going to happen. All right? If you guys know when you're going to die, please let me know. Because I haven't figured out a way to find out the exact date and time. All right? I've been trying, so I'm prepared for that day. But unfortunately, we never know. All right? I thought my mom was going to live forever. She died at the age of 46. We never know. My grandfather on my dad's side died at the age of 50. My father is over 50. So we never know. It's not something in your genes. If somebody died early, you're going to die early. If somebody died late, you're going to die late. It's not in your genes. You don't know exactly when you're going to die. But you have to be ready. I know it's a touchy subject, guys, and I'm sorry, but you got to be ready, okay? Jeff just wrote, they say that every 10 years, something life-changing happens. Absolutely. Tahira, exactly what I was saying before, for college and all that stuff. They can buy a house, they can go to college. Right, let me go to the chat so you guys see it. She just wrote, if it builds cash value, your children can borrow against it for college, weddings, homes, starting a business, or whatever. The cool thing about it is that certain life insurance programs, and I know we're talking about real estate and I'm just babbling here about life insurance, because it's that important. They go hand in hand. It's your biggest investment, $300,000 house. You understand? Right? The point is, by using a life insurance, it's a vehicle. Look, one of these things, like no credit checks for a loan. It's a vehicle to prepare yourselves for retirement. Instead of putting money in a checking account and getting 0.35%, whatever, return, you can get way more. The same. You can borrow money against it, and depending on the program, not even pay anything at all on the interest. So it's a 0% interest, that money that you borrowed. If you have enough cash there, you might not have to pay back either, because it accumulates. So there's so many options. Prepare yourselves. Again, if you have children, prepare your children for that future. You might be able to afford $100, $200, $300 a month, but when it comes time to college, you might not be able to afford the $60 or $70 or $80,000 a year. But by doing this now, by the time that comes, it accumulated enough to help you. Does that make sense? All right. So let's go back to the book. And the point was, again, as the book points out, PMI is not life insurance. So if you die, it does not cover you. It covers the bank in case of loss. It does not cover you in case your loss as a survivor. Okay, so very important. Natalia, what is your life insurance company? I have plenty. I work so through my brokerage. So the brokerage I work with, we have over 150 companies that we can work for, from Transamerica to Prudential, AIG, which is now Voya, like so many products, different products out there. So what I usually do is try to figure out what best matches the client versus what best matches what I'm selling. Does that make sense? There's a lot of companies, like, if you're an agent for Prudential, then all you can sell is Prudential. If you're an agent for Transamerica, all you can sell is Transamerica. All right, so you might not have the best for your clients, but it's the only thing you can sell, so you're going to force that as the only thing that's available. Does that make sense? So I don't like that. Personally, I don't like it. I like to have options for my clients. But either way, even within options, I'm telling you guys information, giving you guys information for you to go and research and be ready for it. Okay? Next. For conventional loans. So you asked me earlier if you could drop the PMI. Private mortgage insurance, right? That's what we're talking about. So this is for conventional loans only. There's something similar for FHA up to a certain year. Not anymore. But right now we're in conventional loans only. You can drop PMI. Sorry. You can drop PMI as soon as equity reaches 20% by calling the lender. Say, hey, lender, I want to drop PMI. I have 20% equity. But the lender has to drop automatically when he reaches 22%. Okay? So that means your value is 100,000, but your loan is at 80,000. So you paid down over the years. So it went down to 80,000, right? Or the equity, the value of the house went up, so you built that equity. If it's 20%, you can call them up and they can drop the PMI, or automatically at 22%. Obviously, a new appraisal might be required, because you calling them and saying I have equity, like, how do they know? I can buy the house today and say I have equity tomorrow. How do they know it's 20%? So an appraisal might be required. Okay? Again, this is only for conventional. Now we have FHA insured loans. So we're done with conventional. FHA insured loans. So FHA, or Federal Housing Administration, they operate under HUD. So they're a department of HUD. Okay, so these are federal programs. Neither builds home nor lends money itself. What it does is insure a loan on real property made by approved lending institutions. It does not insure the property. Just like PMI doesn't insure the property, it insures the loan. Okay? So FHA, what they do is they insure the lender against loss. Right? Against the loss. So the common term FHA refers to a loan that is not made by the agency, but is insured by it. So you're not getting an FHA loan, you're getting an FHA insured loan. Does that make sense? The lending still comes from a local lender. Still comes from a local lender, but it's not made by FHA directly. It's made by Bank of America, by Wells Fargo, or so on. Okay, Blas, I just saw your message. Nice house, man. All right, next. FHA 203B. Now, what is FHA 203B? This is the most commonly used or widely used FHA program. It's the first-time home buyers program that everybody talks about. Okay? The FHA 203B is the first-time buyer program. You could be a first-time buyer again later on. I'm going to talk about that later, okay? But there's always a way to be a first-time buyer, because there's exceptions. There's life events that change your life, okay? So one of the things I want to point out real quick Tomorrow, yes and no. Okay, I'll address that in a second. But one of the things I want to point out real quick. Who knows, before anything, who knows, and tell me in the chat, how much is the traditional down payment on a FHA first-time home buyers program? Some of you are close. Some of you are on the money. Some of you are just playing it safe. The net just went under 5%. All right, some of you are technical, like that, Shirley. All right, guys, so the traditional down payment required for FHA loan is 3.5%, 3.5%. That's a traditional. Can it change? Sure, because it's based on their guidelines. Got it? But the traditional is 3.5%. That means that the lender will give you up to 80%. Let's start right there. And then they'll actually allow to give you a little bit more because the FHA will insure the difference between the 80, right? Between the 80, so that's like the gap insurance, between the 80 and the 96.5%. So that 16.5% is insured by FHA. Did you guys understand? Come up with 3.5% down payment. My question now is, and I think it's very easy to reply to this. Homeowners, can you write in the chat real quick? What type of house did you buy with your FHA program? If it was FHA, what type of house did you buy? Can you write it down in the chat real quick? What house did you buy? All right, so I'm out of row 2 family. Mauricio tomorrow they wrote multi, but multi you're talking about 1, 2, 3, 4. Victoria said single. Sandra go 2 family. Okay. Okay. Single. Shirley, you bought a 1 to 4 family. What I'm asking is, what did you buy? Okay, Mauricio wrote 2. All right, cool. So here's the thing. We have 2 people that bought a single family. We have majority of you bought a 2 family. I just want to point out something real quick. Look here. And nothing wrong, Victoria. You can smile after this. What I'm about to say might hurt a little bit, but you can still smile. Okay, because I know everybody has different reasons why they do this stuff. But to buy a conventional loan, we just talked about 20% down payment. Or if it's your first time, sometimes they bring it as low as 5%. There might be other programs where they allow you lower, but traditionally, the lowest that they'll go is 5%. But if you can come up with 3.5% as a down payment, right? FHA allows you to buy 1 to 4 family. What I want to point out now real quick is your first purchase using this program will be 3.5% down. Let's say you bought a single family, Victoria, right? Now you want to buy a multifamily. Your second home is going to be a multifamily because it only makes sense to get some income, right? You're only going to qualify for a conventional loan, not an FHA loan. But because you already have a home, you don't qualify for a conventional first time either. So your second home, we're going to look at your expense because a single family is strictly an expense. You guys understand? So now we're going to look at that. We're going to look at your income. And wait a minute, you make, let's say $10,000, but you're paying 3, so your actual income is 7. But wait, there's the cost of living, there's loans, there's all that stuff, so now it reduces a little bit more. Let's look at the multifamily. And multifamily, unless it brings enough money, it's going to count against you as well. So now you're going to have to come up with 15 to 25% down payment. You see where I'm going so far? All right, and this is for you guys that got 2 families as well. So don't get me wrong. It's not just for Victoria and Blas, for you guys that got 2 families as well. And again, don't be upset about what I'm saying. I'm just telling you what I believe should be done always. Right? To each his own. Maybe you don't want to have tenants. Maybe you don't want to deal with neighbors. Whatever. But to each his own. 9 out of 10 times, I can convert somebody from a single family to a multifamily mentality, and they purchase multifamilies first. But if with the same 3.5% down payment, you can buy a 4-family, why would you go to the 1-family? The point is, you buy a 4-family now you have money coming in every month that pays itself off. When you go buy the single family, which is expense only, right? The bank is most likely to approve you for lower down payments because, so 15% versus 25%, because you have an income property that's helping. It's a supplement to your income. You guys understand? So it helps you a lot. When you try to do the reverse, where you have a single family, it's like you're pushing your car uphill. It's harder to go from a single family to a multi than from a multi to a single. Okay? And the whole process, if you do it right, I talk about this. A lot of people say that it's tough in today's day and age. It's not. All right? It's not tough. It's a little tougher than what it used to be, but you can still make it. Buy a 4-family, buy a 3, buy a 2, and then you get your 1 and you live mortgage free because the other 3 are paying for it. Maybe you even substitute your salary depending on what you're buying, and you don't have to worry about working anymore. I'm just saying, that's what you should do. Have as many income apartments or units as possible right away. It's only 3.5% down payment. And depending on where you're trying to, I'm not even looking at your comments. I'm going to go there in a second. Depending on what you're trying to buy, a lot of people tell me, let me see if I have the person I'm going to address here in the group. Hold on. Yes. Okay, great. So a lot of people tell me, and I've addressed this, so there's somebody here in the group that will understand what I'm saying, that they want to invest, right? I'm pretty sure all of you have some type of investing mentality at one point, whether it's now or you had it or you just gave up, whatever. But you have an investing mentality. And a lot of you go like, well, I would buy the multifamily, like the 4-family, but I can't, I mean, for us to get the same prices or good prices, it's going to have to be in certain types of areas where the community is not the best and the schools are not the best and this and that, whatever. All right. Understand one thing. If it's an investment property, it does not matter where it's located as long as it gives you a positive cash flow. What is cash flow? The money left over after paying all your bills. Simple. I don't care where the property is located. I don't care. And some of you will go, no offense if you're listening to this. Again, I said there's somebody in the group. So if you're listening to this, some of you are going to go, oh, but I have to live there. Yeah, but you don't have to live there forever. You don't have to live there forever. It's only for a certain amount of time, and then you can move on to another property, and another property, and another property. You guys understand? It's temporarily. How many things, most of us have been adults for a very long time, so let's forget being children. You've been adults for a very long time. How many things in your adulthood have been temporarily? How much did it hurt you for that 1 year or 2 years you have to endure that temporary situation? Damages you a little bit, maybe, but it's gone. Did you overcome that situation? Let me know. Did you overcome that situation? Right? So temporarily. You know what? It could be even 6 months. Only 6 months. If there's some life-altering event, like divorce, marriage, babies, job relocation. Just saying, there are exemptions to the rule. So you get into a 4-family in, let's say, a less desirable area. To your eyes, it's less desirable. To me, everything is desirable. But maybe a less desirable area. You live there for 6 months, a year, maybe 2, right? You deal with it. And then you have enough equity to take money out of that property and dump into another property without losing your first income property. If you do it this way that I'm telling you guys, if you do it this way, and I'm going to talk about this in chapter 17 again. If you do it this way, your first property is the only investment you ever have to make out of your pocket. Does that make sense? All right. So let's go. The hero for some reason is cold. Let's go to the chat real quick. See. I'm sorry, guys. I was not ignoring your messages. I was just throwing a message at you guys. Let's see what we got. So we start off with Brian. And Brian wrote, what if you move out the first home and live in the second? You could. You just have to be there for a certain period of time, or you have to have a life-altering event. Next, Marisa wrote, but AHA loan? Oh, FHA. Gotcha. I just saw that. So, but FHA loan resets after a while. You can use it again after a period of time. So I already addressed is either by a time frame, so after a certain period of time it expires, so you can go back to an FHA, or a life-altering event. Okay, so you'll be able to go back into FHA. Definitely, Shakia. Definitely. Right here. Blas, what if I already have tons of equity in my single family and planning on using it on my next property? It's not about the equity only that you have, Blas. It's also about the income that that property brings. And traditionally, single families bring zero income, but they are an expense. All right, so it's great that you have equity. Obviously, if you've been paying as much as you have twice a month, obviously you have equity. It's great for you to piggyback on it to go to another one. All I was trying to say is that now to get into a second property, you need to come up with 15 to 25% as a down payment. So why not do it with a multifamily first as a stepping stone, right? And leave, like do the same thing you're doing, like dump all the rental income into the loan. You pay it off quicker. Then you have the same equity plus the income still coming in. Does that make sense? Right now, Blas, what you have is a bunch of income. I mean, a bunch of equity, but no income. So that's the only difference. And again, don't feel bad about it. We make mistakes, is the way it is. Maybe not being educated enough, or maybe it's just the way you wanted to do it. Nothing wrong with that. I'm just showing you my perspective and what I think should work for everybody. Shirley, how long do you have to live there? Like I said, it depends on the program that you're getting into, and it depends also on life-altering events. Like I said, getting married, getting divorced, having a baby, job relocation 100 miles or more. There's several other different things that would qualify you for that. Cap rates, we'll talk about that in chapter 17, so I don't want to confuse anybody to here. So we're going to skip that for now. Sonia, what's that face there? I didn't understand the face. Courtney, I think I already addressed that. I'm going to skip Jeff right here. Hey, Jeff, your audio is working, but your keyboard is not, man. Like, what is your keyboard typing here? Seriously. I know it was not you. Just yell. Okay, I already addressed that. Like I said, Tahira is a little cold for some reason. So that's a strategy, the diverse strategy, okay? Don't send me anything private because it will show up here in the chat. Do not send anything private. It will show up in the chat. Blas, my girlfriend was supposed to be temporary. Now I'm married. And that's how you got into the house? That's funny. Anyway. Courtney laughs. Shirley. I'm going to be a first-time home buyer, says Shirley. Okay, great. I buy a house when I was young. Can I put my husband as a first buyer? So what I would recommend at this point is talk to a mortgage professional, and they will see based on your current situation what you qualify as. But traditionally, yes, both of you can be first-time home buyers depending on how it was purchased initially. Okay. Blas, about to start renting the rooms. Go ahead, rent them out. Ciel, if I get a house with another person, does both have to be living in the house when they purchase? No, I can be a co-borrower, right? I don't have to live there. Okay, Sonia, was the message for you? I don't know. If the hat fits, maybe. I don't know. The message was for everybody. It was for 37 people on the line right now. All right, guys. So with that being said, we were talking about FHA and getting into a 4-family or 3-family before getting into a single family. So make sure you guys think hard about this. 3.5% down payment versus 15. Okay. Again, there's nothing wrong with making the decision of going to a single family. I'm just giving you the heads up to now go to a multifamily, an income property. It becomes a little bit more difficult. So instead of going downhill where you speed up and it's way lighter, you're going uphill and you have to push that that car or whatever you're pushing all the way up. It's just tougher. That's all it is. Can you still do it? Can you get into a multifamily? At any time. Just the programs, again, become tougher. Now, look what it says here. It says an upfront single mortgage insurance premium, or MIP. Do you see it? It's not called PMI. It's called MIP. So for FHA, it's called MIP. Okay? So I just addressed Jessiel right now. I just addressed Jessiel. It says upfront single mortgage insurance premium is the equivalent for the PMI in conventional. We just call it MIP because it's built into the loan on the FHA because they pay the government. Okay? All right. Now, this could be paid in cash or added to the loan, and it's usually a 1.75% lump sum premium of the loan amount. So that's 1.75%. Look at this right here. We're going to end with FHA and then we're going to go into the break, okay? So right here. FHA allows for any or all the down payment and closing costs to be a gift, not a loan, from the borrower's relatives. Can you get money from a borrower? So addressing everybody on the line, even though I had this question specifically from one person as well. Can you get money from relatives to help you buy the house? Yes, but it cannot be a loan. It has to be a gift. They're going to have to sign a document that says, I am gifting and I'm not expecting money back. So it's an affidavit that says, affidavit or contribution that says, I am gifting, I'm giving it without expecting it back. Okay? So very, very important that you understand this. When you ask for money from family members, make sure they understand that they don't get it back. They have to sign something. Okay? And if you have family members that will give you $15,000, $20,000, $30,000 gifts, remember, I am part of your family. I will accept that money too. Okay? Just saying. Now, Jeff, you're so much trouble, man. I'm not even reading the whole message, and I already know that I cannot I cannot go back to that chat right now. I just read part of it. All right, so let's go here. In addition, a willing seller may pay points and furnish money to establish escrow account payment of future property taxes and insurance premiums. This is called seller's contribution or seller's concession. So we can ask the seller, hey, Mr. Seller, would you consider, I'm offering full price offer, right? I'm offering a full price offer. Would you consider contributing $10,000, for instance, towards closing costs? Would you consider $15,000 towards closing costs? Whatever it is, the higher the amount of the purchase, the more you can ask. But it can never exceed 6% of the loan. Can the seller help you buy? Yes. All right. If we're in the market where it's difficult to sell, most sellers will kind of agree to it. If we're in the market where there's too many buyers and not enough sellers, it becomes tougher. So like today, we're still in the seller's market. So the sellers can demand whatever they want. It will be tough to get the seller to agree to contribute. Can you still put it out there? Yeah, why not? Mr. Seller, Mrs. Seller, would you consider X amount of dollars towards closing costs? Why not? All right? Because remember, a lot of people think that 3.5% is all you need. No, it's not just a down payment. There's closing costs. We'll talk about it in chapter 21. There's a lot of costs with the purchase of a house. So you need to come up with 5 or 6% in total towards the down payment and closing costs. Can we ask the seller to contribute part of it or all of it? Sure. Okay. You guys got it? Now, for FHA loans, remember we talked about in conventional you could drop. Blas, I have a feeling you're going to write more after that. Okay, there you go. So I told you in conventional that we had PMI, and the PMI we could drop once you reach 20% equity, right? FHA until 2013 was very similar. In fact, as soon as you reach 78% of the original loan, right, original appraisal, you can drop. So that's the 22% that we saw in conventional, right? You can drop the PMI or MIP in this scenario, right? The thing is, right now, you cannot anymore. It carries for the lifetime of the loan. So if you want to drop the MIP in the FHA, you convert it to a conventional. You have to refi out. It carries for the lifetime because of the experience that they had with the market drop. Okay? You guys understand? So for state exam, between January 1st, 2001, just remember 2001 and 2013. Between these years, as soon as you reached 22% equity or 78% balance, you could have dropped the PMI or MIP in this scenario. Okay? Let me see what we got. Chat. Jasiel, it's not paying less than PMI. It's still the premium is going to be there. The actual FHA MIP is actually a little bit higher than the conventional PMI. We're going to skip this. And Blas, you wrote closing costs almost killed me. So you put a down payment and you paid for a closing cost yourself. That sucks. How much was it? Was it the same as a down payment? Was more than a down payment or a little bit less than a down payment? $15,000 at closing, towards closing costs. And how much was the down payment, if you don't mind me asking? You don't want to tell me? Okay. So remember what I said? It was going to be roughly 5 or 6% you needed to come up with. He put 15,000 towards closing, 18,000 towards down payment. So I'm not far off of my calculations. Anywhere between 5 to 6% total. So in this case, it was like 5% was down payment plus. So it's very similar. That's what I'm trying to say. I'm sorry. Very similar. Now, refinance after 78%. All right, Blas, I'm going to address this in a second because this is very important for all of you to learn. Okay? Let me see what's here. Courtney asks, so refinance after 70% or at any time if you want to drop MIP? As soon as you can convert to a conventional, do it. That's the bottom line. So always keep a good communication with your mortgage professional that got you the loan if you liked it, okay? And to convert to conventional, you don't need to be at 78%. But if your loan originated between January 1st and January 13, right, then this is still there. Once you reach a 78, you can ask FHA to drop it and you keep the FHA loan. What I'm telling you is loans after that, or even before, or at any time, if you have enough equity according to the conventional FHA, the conventional loan programs, if you have enough equity to refinance, do it. Okay, right away, do it. By the way, never refinance to another FHA. I had that in my class. A student came to me in the beginning, like the second or third day of class. She came to me and says, Bruno, what do you think of this? When I looked at it, it said refinance and FHA, and then the amounts of fees that they were charging, it didn't make sense. So I called one of my guys and I asked, hey, listen, this is what's happening. The first thing he asked me was to look, again, confirm that it was FHA. He said yes. I said yes. And then he asked me to look at the origination fees and a few other things that were being involved here. And he's like, why are they putting her into another FHA? So she's going to have PMI again. She's dropping the rate, but she's going to get stuck with PMI again. So not much of a difference. So she was going to save, I think, $100 or $200, $150 or $200 around there. After refinancing with the person that I introduced to her, she actually dropped roughly $320. No PMI, right? And she has she kept a lot of the equity because the fees were not built into the loan. So it didn't drop that much on the monthly compared to the previous one, but she didn't carry over additional costs, which would be from the originations. You understand? So be very careful with that. So, Blas, let me address this real quick. Tidy, I think you're talking about same here in regards to what Blas wrote. So here's the thing, guys. No offense to whoever, because I don't like to offend anybody. But no offense to whoever used as a realtor, if you did, Blas. But if you did not know, it's your realtor's fault. Right there and then. Chapter 21, I'm going to show you that you should be able to estimate, and I just did for you. I just told you how much the closing costs are going to be, more or less, right? It's a little bit less than the down payment in this scenario, right? I was very close to it. You should be able to estimate or guesstimate how much is going to cost in closings. But I just said earlier that you have the LE and you have the CD. The loan estimate is given to you as soon as you apply for the mortgage. One thing is getting a pre-approval, another thing is getting a commitment. So you got pre-approved, which is a semi-commitment, right? And then you say you want to proceed. This is the house. At that point, they give you an actual approval, which is the LE, along with that booklet. You understand? So they do give you the estimate. It is there. I'm going to show you tomorrow. I'm going to show you that it's been there. The estimate of closing costs. So if you do not know, one, it's the instruction manuals that you never read. It was given to you. Remember I said that before, guys? And two, your realtor did not point it out to you. And three, the loan officer you used did not point it out to you either. That sucks. Again, no offense. I'm not trying to say that you have a good or a bad realtor, but I'm telling you it is your realtor's fault. You guys got it? If you're just looking for the money, and I'm not saying that's what Blas, I'm not saying that's what your realtor did, but if you guys are just looking for the money and you oversee things like this, what if Blas did not have money? I'm not reading your messages, guys. Sorry, I'm not there yet, because this hurts a lot of people. And I'm talking about realtors. Guys, pay attention. I'm talking about you. This hurts a lot of people. I'm not even talking about your client. I'm talking about you. What if Blas did not have the money to actually close? If he didn't have the $15,000 closing costs, would Blas close? If he doesn't close, what happens to your commission? None. So you guys are working against yourselves for not being ready. That's what I said. You got it? Sorry, this is part of the agent training, but you are agents in training. You're getting there. That is so awesome. Your credit went up. You have equity. Ooh, beautiful. From 5.2 to 2.9. Woo. That was so awesome. Oh, please don't tell me this. Are you guys reading this? That hurts. That's not an excuse. Courtney, thank you. Yes, absolutely. Love it. Yes. Guys, you have to remember one thing. You guys are going to forget everything that I just said. Anyway. It is overwhelming, guys. Don't get me wrong. It is overwhelming once you get your license and actually start doing this. But then there's agencies that train you well. There's agencies that don't care. There's like, it all depends on where you're going to go. There's great agencies out there. There's great brokers and great training programs out there. Shop around, like I said. All right. Hey, Blas, if you don't mind, separately on the Facebook or on the WhatsApp, can you tell me the name? I can roast them a little bit. I'm going to have so much fun. Anyway. All right, back to this. We're almost done. We're going to go to a break. Back to this real quick. There's one of the things that I don't like about FHAs. It's called estimate of value. Now, understand. Oh, he is a good guy. Buzz. He is a great guy. And his in-laws too. All right? Know them very well. So, estimate of value. This means they have to appraise the property, like all mortgages do. But FHA will give, FHA will give a maximum loan amount according to the estimate of value. So it's not the purchase price, it's whatever was appraised. So if you're buying a house that's $100,000, but it's appraised for $98,000, but you still want to buy, you have an option. You have an option to pay the extra $2,000, or you have an option to decide not to purchase. And this is the thing that I don't like about it. What do you think is going to happen most of the times? Are the buyers going to come up with more money, or are the buyers going to walk away? I want you guys to keep in mind one thing. Most people that go for FHA programs, the majority of people that fall into the FHA program, cannot afford a house under a conventional loan. Most of them. And also FHA is not available everywhere. It's only in certain areas. So most people that go into this most likely don't have the extra cash. So they will most likely do what? Not purchase. So do you see why it's so important to be accurate in your profession? In estimating values, not just put offers. I see people sometimes, they just put offers on properties without knowing if it's worth it. Right? Look at it. Don't believe what the listing agent put there. Don't believe what the listing agent put. Check the values. Do your comps. Is this worth it? Should we put an offer? You got it? Because if it doesn't appraise, then you either come up with the money or walk away. The other thing I don't like about FHA is, we're on page 199, is the repair requirements. I was just talking to one of our agents here, the one that brought me the coffee that I still did not touch, unfortunately. Let me just, a little cold now. But one of the things that I don't like, and like I said, I was talking to one of our agents here, is FHA has repair requirements, and their repair requirements are ridiculous. I had, true story, I had a property close by to here to the school that I sold 4 years ago. And the buyer was came with a Wells Fargo loan, okay? Wells Fargo sent the appraisal. The appraiser looked at the property, made the appraisal, and put some notes on the condition of the property, which is normal. And one of the notes says that the window frame in the back, so the exterior frame, all the way in the back that goes to the backyard, the paint was chipped. Some of you have been in my class before, so you know this story. This was 4 years ago, so you definitely know. The paint was chipped. And they wrote on the report, roughly $500 to fix, and clearly wrote as well, does not affect the property value. Clearly wrote, does not affect the property value. $500 to fix, chipped paint. Guess what Wells Fargo did? They forced me to fix the problem. They would not issue a commitment to the buyer. They would not issue the commitment to the buyer until I, the seller, fixed the problem. Well, it cost me $7 or $8 to fix, but called the paint and the brush. But $500. I don't even know how this guy came up with $500. But $7 or $8 to fix, and I had the appraiser come back. Came back, checked it out, everything was good, submitted to the bank, finally got the approval. But you guys understand what I'm trying to say? Their requirements, depending on the lender that you have, they are very strict with it. Some lenders, they're like a little bit more flexible, they'll ignore. That's why I don't like to deal with big banks like Bank of America, FHA, Wells Fargo, and all that. I don't like to deal with them because they nitpick at these things. So, but that's one of the things. Nanette wrote the same thing. She had the same scenario. She had to paint a wall. It's paint. Come on. It doesn't affect the structure of the house. It's not going to fall. You guys understand what I'm trying to say? It is a great program. Don't get me wrong. It enables a lot of people that couldn't otherwise be able to buy. It enables a lot of them to be able to buy and become homeowners, right? But if you are not ready as a realtor to educate everybody and walk them through the process, it could hurt you at the end. And what I'm saying here is no short sales, because most of these are properties that have damage. No foreclosures, because again, most of these are properties with damage. You understand? Try not to use FHA programs to buy these types of properties. You're hurting your buyer because they're going to waste time and they might not be able to buy. Unless you have an FHA 203K, which is strictly for construction. It's already specific for this. And usually are longer periods of time for it to get approved. So you don't close in 1 month. You can close in 3 or 4 months if it's a 203K, or even more, depending, because we need the estimate of repairs, you need a bunch of certificates, this and that, whatever. HUD, BLAS, the same thing, because a lot of them, again, guys, I'm not telling you not to. When I say no short sales or no foreclosures, like I said, or no HUD, as Blas just asked, what I'm trying to say here is you need estimate of repairs. And I just told you that for $500 chipped paint, they almost did not issue a commitment. In all these scenarios, do you think the lender is going to fix? Do you think the seller is going to fix? They're already losing their home. They're not going to fix anything. So now you have to come up with the money as a buyer. You understand? And the lender has to agree to allow you, the buyer, to fix the problem yourself. Are you guys understanding? This becomes a lot more complicated. So these are not the right programs for investors. Short sales, foreclosures, HUD with an FHA, not recommended. Could you get a good deal where the house is in okay condition? All you need to do is paint, and like you commit to paint the property? That's easy. Could you? Yes. Could you get an auction property that's actually not damaged? You could. How many of those are you going to get? Are you guys understanding my point here? Yes or no? Yes or no? Okay, so don't waste your time. Make sure you talk to your clients and explain. Unless you qualify for an FHA 2 or 3K, let's not even look at these. And even if you do, just be aware, right? Just be aware, and I talk to all my clients about this, be aware that it is difficult because you are an FHA, all right? Another thing I want to point out, right now, FHA 2 or 3Ks are kind of like on hold. So they're a little stricter in the guidelines, again, because of what's happening, so it's risky. But just be aware of that. If when you're working with a buyer, let them know that even though the program still exists, obviously, it might be more difficult at this time to get approved for it, okay? The final thing, and then quick break, the final thing is this. You guys were asking me how long you have to live there. Well, it doesn't say anywhere here how long you have to, right? So You have to check with the mortgage professional how long you have to. But what it does say is that with certain exceptions, the borrower must intend to occupy. You guys read it? With certain exceptions, the borrower must intend to occupy. That means what? That means that your intention was to move in, but then something happened in your life. That's what we're talking about, life-altering events. You intended to occupy, but something changed along the way. It was me and my wife. It was me and my husband. It was me and the partner. It was me with whatever. Or I lost my job. Or, I got offered a better job 100 miles away. Whatever it is. You might be able to get out of this program and get into another one. Or move to a different house while keeping this. Are you guys understanding this? So, it's not me saying it. I say a lot of stuff that's not in the book, but here it is. So, yeah, Jeff just goes like, yep, he cleared it. Washing my hands. It was not me. All right, guys, so we're going to go into a quick break. It's 7:55, roughly 5 minutes. So 8 o'clock, we're going to come back. We can finish early, okay? If you have any questions, start dropping in the chat. And when I get back, I will address them. Be right back.